So let's move on to the questions. We've gotten quite a few of them. Thank you very much for those of you that have submitted them. We have 80, believe it or not, thus far. But if you have some additional ones, please submit them via the right-hand side dialog box. So scanning these over as you were presenting, Rob, I think the far and away the most popular question is, what is your response to competitors and or research studies that say that factors cannot be timed?
If those studies suggest that factors cannot be timed in the sense of picking the best and worst performing, of course that's true. If the suggestion is that it's a fool's errand to test whether a strategy is trading rich or cheap, and to de-emphasize strategies that are trading rich relative to historic norms, people can believe whatever they want to believe. But the empirical evidence is overwhelmingly clear that valuation matters. Buying strategies when they're trading cheap works better than buying strategies when they're trailing 1, 3, 5, and 10-year performance is best. This doesn't mean you're building a bigger value tilt necessarily. Value itself can trade rich or cheap relative to its history. We saw on that graph that value is sometimes a third the price of growth and sometimes a 1/12 the price of growth. If it's a third the price of growth, it sounds like a big gap, but it's not. It's narrower than historic norms. That's a time to shun value. When it's trading cheap as it is now, that is not a time to move away from value. And yet we see lots of investors trying to figure out how to diversify their value exposure. That is factor timing. And it's factor timing in the wrong direction at the wrong time.
So what would you advocate would be a reasonable time horizon to practice this contrarian-oriented investment style between these various strategies?
Any strategy can have disappointing years. Any strategy can have a disappointing 2 or 3 year span. I would say that when you're pursuing a strategy, if it has performed badly for 3 years, ask the question, has it performed badly because it's become cheap? If it's become cheap, you might want to ramp up exposure instead of ramping it down. Now, as for factor timing itself, factor timing can have disappointing years and can have successful years. So there, once again, if you're engaged in factor timing, be patient. You may find that even a cautious, moderate shift in factor tilts can hurt your results for a short period of time. So I would counsel patience and a recognition that the goal here is long-term performance. The goal here is to make ourselves better off than we could have been otherwise over the coming 5, 10, 20 years. It's a squishy answer to a squishy question.
Well, I think that's a good segue into another question that asked if plan sponsors notoriously fail at market timing. These are entities with long time horizons, but still, despite these long time horizons, they engage in a host of short-termism. I think Goyal Wahal's 2008 article highlighted this, and I think you showed something just a moment ago that dollar-weighted returns trail. So if people are doing this poorly with, say, investment managers, what makes you think that they will be any better in terms of smart beta strategies? Shouldn't they just buy into a set of smart beta factors or strategies and set it and forget it, so to speak?
Well, there's an element of don't do this at home, folks, to my advice. Most people, and especially most investment committees, will feel overwhelming peer pressure to chase what has performed best in the past. Relative to performance chasing, just statically weighting a bunch of factors equally is a big step in the right direction. Relative to wherever you are right now, moving to that equally weighted roster of exposures might not be well timed because you are factor timing when you embrace that strategy. I would say if you want a diversified roster of smart beta strategies or a diversified roster of factors, check what's trading cheapest, buy it, keep doing that until you get to a more diversified portfolio. If you want to add a little bit of additional return, and if you have an investment committee that can stomach the contrarianness of it, then definitely continue to check what's cheapest and move more into whatever's cheapest and out of whatever's trading most expensive. I guess my last observation was, when you think of equal weighting multiple factors, you kind of think, okay, I'm going to get the combined average of historic performance. Well, that historic performance all too often is paper portfolio performance. And the reality is likely to be considerably worse than that. You saw my exhibit that showed that after publication, well over half of the alpha of factors disappeared. Okay, so if you have a carefully crafted multi-strat program constructed and built based on past backtests, don't count on that backtest performance in the years ahead. Give it a haircut of at least 50% in terms of shaping your expectations. If you don't do that, you're setting yourself up for big disappointment.
So the other thing that we have a question here that backtests don't include is transaction costs. So we have a question here that says, have the turnover costs implicit in the bid-ask been calculated in these in this study?
Short answer to that question is no. And the higher the turnover of the factor or the strategy, the bigger the haircut you're going to incur as you go from using the factor on a paper portfolio to using the factor live. The question actually anticipates some work that we're likely to be publishing in the coming year, which shows that there's many a slip twixt cup and lip, and factor returns as delivered in funds is in many cases a lot worse than the paper portfolio returns. It's going to be an interesting and provocative paper.
But presumably, the transaction costs would impact both the trend chasing, the equal weight, and the contrarian strategies all in one form or another.
So the question is trading costs as it relates to active shifts in style. Short answer to that question is, as you move from one style to another, if you do it in a moderate fashion, not an aggressive fashion, you're not likely to be adding a lot of incremental turnover, but you will be adding some. So it's important to recognize that the incremental return for successful factor timing is probably a little less than what shows up in these historical tests, and the penalty associated with performance chasing, which is what most people are doing, is likely to be worse than what shows up in these historical tests.
So one of the things we get asked a lot is about value traps. And so one comment here was, I agree with trading cheap relative to historic norms, but how does one go relatively cheap and avoid the extremes and the cheap for good reason value traps across these different factors and smart beta strategies?
Sure. Well, value traps exist in individual stocks. It's implausible that value as a strategy suddenly becomes a value trap. Value as a strategy will draw you into cheap stocks, some of which individually are value traps. So that's the big distinction. When you're looking at factors, smart beta strategies, anomalies, you're likely to be looking at strategies and factors that are not vulnerable to the value trap except in individual stocks, and likely to be not materially more or less vulnerable to value traps in one cycle relative to another.
So there's a takeaway here that as you access these strategies, make sure they're not so concentrated that you can get hit with that
That's
sort of
a very,
idiosyncratic
very
risk.
good point. That's a very good point. Every single thing that we tested here is a broadly diversified strategy. If it's a factor, it's got 30% of the market on the long side, 30% on the short side. Now that's a moderately diversified portfolio, but with big factor tilts. And the smart beta strategies are 100% long an array of stocks, no long short portfolio. And in terms of the active share, the departure from the cap-weighted market, might have active share of 30 to 70%, roughly a fourth as much active share as you get with factors. Interesting that you get 2/3 as much alpha as you do with factors, even though you've got 1/4 as much active share.
So I want to go back to your paper portfolio comments earlier. We have a question here from a listener. Do you have any thoughts or concerns on whether the now widespread availability of historical data, current data, and massive computing power has made the persistency of either smart beta or its historical patterns less likely to repeat in the future?
Oh my goodness, yes. Whoever sent in that question, thank you. I'm a quant. I've been a quant for 40 years. One of my frustrations with the quant community is that you have tens of thousands of quants studying the same data, using vast data that's almost free, using computer power that's enormously powerful and almost free. They're all studying the same data. They're all identifying variants of the same strategies and ideas, and they're all thinking past as prologue that it'll work. Maybe not. You want to be really careful. You want to haircut expectations. The more heavily you've data mined history, the bigger the haircut you should give. And I think there's a very serious risk that back-tested factors that were identified because they worked so brilliantly, and that worked so brilliantly because they were getting more expensive, are seducing a lot of quants into creating strategies and products that are likely to disappoint. In many cases, where the customer thinks they're going to get 2, 3, 4% alpha per year, they might very well wind up with -2, -3, -4% as valuations mean revert on some of these strategies. Mean reversion is the most powerful engine in the capital markets, and it's the most underrated because mean reversion requires us to buy what's inflicted pain and losses and sell what's given us great joy and profit.
How much do investors need to be cognizant of duration risk in these strategies?
Oh, that's an interesting one. Some strategies, notably value strategies and dividend strategies, have a slightly higher correlation with the bond market and therefore a longer bond duration, hence a higher correlation with the long-term spending intent of the end investor. So that's a nuance that I think is important, particularly for institutional investors that are trying to match some liability stream. LDI strategies, liability-driven investing using duration-matched long bonds, very, very popular. Well, what if you take your equities and tilt them in the direction of picking up a year or so of duration just within your equities by having a value tilt, having a dividend tilt? It's an interesting complement to the portfolio when you're looking at the portfolio as a means of serving long-term real spending needs.
So one of the questions a lot of people use our asset allocation site to formulate expected returns for various asset classes. And so one listener said, can smart beta timing be combined with weighting towards higher expected return equity markets? Any thoughts there?
Short answer is absolutely yes. My largest single personal investment is fundamental index in emerging markets. It's a combination of a strategy that's trading abnormally cheap. The Shiller PE on fundamental index in emerging markets is 8.5. You can buy half the world's GDP for 8.5 times the sustained long-term earnings. My goodness, that's cheap. And astonishingly, that's after nearly a 50% bull market since January. Wow, up 50% and still trading at 8.5 Shiller PE. That means it was less than 6 Shiller PE at the lows. So short answer to the question is yes. If you're looking at our asset allocation website, and thank you for whoever asked the question, thank you for your trust and confidence in our work and your use of that website. That website is powerful, but it deals with asset classes on a cap-weighted basis. And if you take an asset class that's cheap and you buy a smart beta strategy in that asset class that's trading cheap, well, that's a really nice combination.
And how often do investors do that?
Most investors won't do that. Let me flip it around and pose the question to the listeners. How many of you, when you're looking at your 401k options, scan down the list of choices and ask, which of these funds and strategies has had really wretched performance in the last 1, 3, 5, and 10 years? Maybe I should buy that. I would venture to guess not 1 in 1,000 investors manages their money that way. And that would work, I pretty much guarantee that would work better than the classic approach of scanning down the list and saying, gee, this strategy has done really nicely over the last 1, 3, 5, and 10 years. It's got to be awfully reliable. Let me put my money there. That's a formula for disappointment.
So to what extent does this timing-based focus require a more active approach to portfolio management? And how does this fit with the definition that you put out previously in terms of what smart beta should be?
It is active. It's not wildly active, and it is not more active than most investors already are. How many people on this call, on this webinar, leave your portfolio unexamined with no shift in mix of strategies, mix of smart beta strategies, mix of factor tilts, mix of asset classes, unaltered for years at a stretch? Almost everyone makes changes in their portfolio. So the question here is not, are you going to incur costs by making changes? You're going to incur costs by making changes.
And you're already making the changes.
You're going to make changes. So why don't you make the changes smart?
And I think in some regards, if you think about this, aggressively rebalancing into things that have become cheaper is something that's already embedded into the fundamental index, which is really the very beginning of, in our minds, the smart beta proliferation, which we view as undoubtedly a positive thing.
Yeah, some of our critics suggest that, these people with fundamental index seem to think they know better than the market what the fair value of a company is. No, we don't. In fact, we can prove the market knows fair value better than we do. That could be a webinar of its own. Some suggest that it adds value because of the fundamentals. No, it doesn't. It adds value because it contra-trades against the market's most extravagant bets. And so whatever has won most extravagantly in recent years, and if the underlying fundamentals haven't rallied as much as the share price, you're going to rebalance out of that stock. Not out entirely. You're just going to reweight it downward. And whatever has performed miserably, unless its underlying fundamentals have deteriorated just as much as the price, you're going to rebalance into those stocks. So you're profiting on the basis of long horizon mean reversion. And so it is built into fundamental index. It's also built into equal weight. Equal weight has identically the same alpha engine as fundamental index, long horizon mean reversion.
And so we've already got these within the strategies, and we're really talking about doing this across the strategies.
Exactly right. Yeah. To the extent people want to use multiple strategies, you would do well to examine, is the strategy trading rich or cheap relative to its history? For the institutional clients who are on the webinar, how many times have you asked a manager, how expensive is your portfolio relative to the market? And how does that relative valuation compare with your own historic norms? I would venture to guess nobody on the call asked this question. And in fact, in a hire-fire decision, do you want to hire a manager? Do you want to fire a manager? If you're hiring a manager, chances are you're hiring them based on wonderful past returns. You would do well to ask the question, is your strategy trading cheap or rich relative to its own history? I would venture to guess 9 out of 10 managers who are considered candidates for new business because of wonderful past returns are also trading rich relative to their history. And a decent fraction of those who are on watch lists or facing a risk of termination, some of them are trading really cheap relative to their history. You don't want to fire those ones. You want to fire the ones that are trading rich and have not delivered the goods.
And so I think that sounds an awful lot like a value-oriented investment process. And so we have one question: if you're using value to time these factors, whether it's recent performance or it's relative to their own historical range of valuations, to do this sort of timing, are you just embedding more of the value factor into those contrarian approaches?
In a very limited way, yes, but here's a thought experiment that proves that it's not a significant increase in your value tilt. Value itself is a factor. If you have a strategy that takes value when it is trading cheap and uses it, and takes value when it is trading rich relative to its history, not relative to growth, but relative to its history, and abandons value at those times, well, gosh, you're actually shifting away from a value tilt. So the fact that this deliberate use of risk-controlled, broadly diversified factor or smart beta timing hinges on relative valuation of the strategies doesn't ramp up your value tilt by much, because you're going to be shunning value from time to time.
And so one of the things people look at a time series like that, and they say, oh, there's greater returns there. And so a question we used to get in the early days of our RAFI presentations is, does a widespread use of this approach being timing across these different factors or smart beta strategies, not run the risk of investors crowding into these same factors using the framework that you just described, and therefore subsequently eroding the available alpha?
Short answer to the question is, of course. The more people use a particular strategy, the more you arbitrage away the alpha. Simple fact is, as long as you have a ready counterparty on the other side of your trade, you have a good shot at sustainable long-term alpha. Who's the counterparty on the other side of these trades? It's the trend-chasing investors, and they are legion. And I think they always will be legion. So at least as long as I live, I don't expect the alpha from this to go away, except for short periods of time when it has a bad year once in a while.
So maybe one of the last questions we'll get to is, at the beginning of the year, research affiliates assessed the potential of smart beta to go, quote unquote, horribly wrong. To what extent has this, and this being your current research, alleviated these fears, these 3 papers, and where do you think we are in that cycle?
Well, I think it really depends on definition of terms. I would argue that if you embrace a strategy, simplistic low beta has had a wonderful 15-year run. It's had a wonderful 15-year run in part because it's gotten very expensive. Why should low beta stocks be higher multiple than high beta stocks? That's the opposite of the historic norms. And yet that's the current reality. So if you have a strategy that anchors on beta, it's performed brilliantly, 500 basis points per annum value add over the last 15 years. If you buy a strategy expecting 5% alpha, and you get minus 3% alpha in the future because those stocks are mean reverting back towards historic norms, I would posit that that is smart beta going horribly wrong. So the point of that first paper was not that you're going to see thousands of basis points of underperformance, but that you're going to have results in many cases way below your expectations if you're performance chasing. And the simple fact is the vast majority of investors chase performance.
And I think that's one of the takeaways for me as the former consultant is these strategies, and this may be the last question that I get to, is these strategies really require a substantial amount of due diligence. In terms of what the likely transaction costs are going to be, where they're trading relative to their history of historical valuations, how much of the returns over the last 5, 10, 15 years really come from something that's more situational alpha versus something that's structural. And I think those are questions that really need to be addressed as we move into this space. And so with that intro, maybe this is a layup question. Has smart beta become a crowded trade distinguished only by the level of fees?
Short answer is no. Longer answer is there are some elements in the smart beta world that are very high turnover and as a consequence have startlingly small capacity. Momentum's an example. And so my question would be, are momentum strategies likely to deliver the performance of the paper portfolio momentum factor? And I would think there's liable to be disappointment there. If you're looking at smart beta broadly, even with a liberal definition, you're looking at, let's say, $500 billion to $1 trillion invested out of a world market cap of 70 trillion. It's barely 1.5% of the market. So if you're looking at relatively low turnover smart beta strategies, I think there's plenty of room for them to continue to add value. That said, I would suggest people should be careful, and when you're selecting these strategies, ask yourself the question, am I chasing performance if I move from where I'm invested today to this new strategy? If I'm making that shift because of a paper portfolio result or a live result that's wonderful, then maybe I ought to ask the second question, is this new strategy trading rich relative to its history, just so that I can avoid some daunting disappointments.
I think that's a great way for us to end the discussion. Thanks, Rob. There are still a number of questions in the queue. I think I mentioned 80. I think we got to maybe a dozen or so there's quite a bit left. Please continue to keep those coming. Our distribution team will put out a document that answers the questions that we didn't get a chance to address today on the call. A replay of this webinar will also be available later this afternoon on researchaffiliates.com. If you're part of our mailing list, we will let you know when both the questions are answered as well as when the webinar has been posted. For those of you who have not yet subscribed, please, by all means, you can do so at our website, researchaffiliates.com. I mentioned a moment ago, a lot of investors increasingly using our asset allocation tool. We very shortly expect to have the ability to save portfolios so you can come back or access them on multiple devices. So there's lots of reasons to register on our website. To those of you who spent the last hour with us, thank you very, very much. We appreciate it. Last item before you go, we always appreciate feedback. We like to say at Research Affiliates, feedback is a gift. We get a tremendous amount of future homework, interesting areas that we can do research that can benefit all of you. So by all means, not only tell us how we did on this webinar, but let us know on additional areas that you would find of interest to navigate what we think is increasingly a complex area of the market in terms of the number of strategies that are being launched, the number of claims being offered out there in smart beta and factor land. So again, thank you for joining us, and we look forward to future discussions.